Hi, I'm Sugandhi Suresh, Assistant Professor, Department of Economics, Jyoti Engineering College, Churduruthi. Today we have to discuss about national income. National income can be defined differently. From the income side, it is the sum total of the factor incomes received by the residents of a country in the form of rent, interest, wages, profit over a period of 1 year. Factor income means the income received by the factors of production. Factors of production includes land, labor, capital and organization. From the output side, it is the total money value of all final goods and services produced in an economy during an accounting year. The next term is gross domestic product at market price or GDP-MP. It is the money value of all final goods and services produced within the domestic territory of a country during a financial year. Money value is the price of the product. To estimate GDP, value of final goods alone are taken into account. Further, the value of goods and services produced in the domestic territory alone will be taken into account. That is, the goods produced outside in the country by the nationals will not be taken or will not be considered. The next term is net domestic product at market price or NDP-MP. When depreciation is deducted from GDP, we get NDP. Depreciation is the loss in the value of capital assets due to wear and tear during production. That is, NDP-MP equal to GDP-MP minus depreciation. Therefore, to find net value of any given gross value, depreciation is to be deducted. The next term is net national product at market price or NNP-MP. GDP includes the money value of goods or income generated within the domestic territory only, but a nation also gets income from abroad. When net factor income from abroad, that is NFIA, is added to NDP, we get NNP, that is net national product. Thus, the difference between domestic product and national product is NIFA. NIFA is the difference between factor incomes received from abroad and factor payment made to the rest of the world. For example, every year India gets a factor income in the form of rent, wages, interest, profit, etc. from other countries. At the same time, factor payments are made to other countries for making use of their factor services. The difference between these two are called NFIA. That is, NNP-MP equal to NDP-MP plus net factor income from abroad. The next term is net national product at factor cost or NNPFC. Market price includes indirect taxes and subsidy. The main difference between market price and factor cost is the cost needed to produce a product and market price is factor cost plus profit minus subsidy. Market price includes indirect taxes and subsidy. When the effects of these two are eliminated from the value of output, we get the value of output at factor cost. To estimate the value at factor cost, net indirect tax is to be deducted. Net indirect tax is the difference between indirect tax and subsidy. That is, NNPFC equal to NNP-MP minus net indirect tax or NIT. NIT is equal to indirect tax minus subsidy. NNPFC is the national income of a country. That is, net national product at factor cost is considered as the national income of a country. The next is per capita income. It is the income per head. In other words, it is the average income of the people of a country in 1 year. That is, per capita income is calculated national income divided by population. The next term is GNP deflator. This is an adjustment factor used to convert nominal GNP into real GNP. It is the ratio of price index number or PIN of a chosen year to the price index number of the base year. PIN of the base year is always considered as 100. The chosen year is the year whose real GNP is to be estimated. PIN is actually price index number is a percentage number that shows the average change in price of a basket of goods over a period of time as compared to prices in the base year. Base year is a standard year taken for comparison and its PIN is taken as 100. In If PIN for a year is 125, it means that there is 25% increase in the price of goods and services when compared to base year. Here, GNP deflator equal to PIN of the chosen year divided by 100. Real GNP equal to nominal GNP divided by GNP deflator. The next is measurement of national income. There are three important methods using to measure the national income of a country. First one is product or output method, the second one is final expenditure method, and the third one is income method. The first one is product or output method. Under this method, GDP is estimated as the sum of money value of all final goods and services produced in the domestic territory of a country during a financial year. We can arrive at national income once GDP is estimated. The following are the important steps involved in the estimation of GDP. The first step is to identifying the production units and classify them under respective industries and each industries under corresponding sector. There are mainly four sectors in an economy: primary sector, secondary sector, tertiary sector, and foreign sector. The second step is identifying the production units and classifying them under respective industries and each industries under corresponding sector. Estimate the value of final output produced by each production unit, each industry and each sector. The sum of values of output produced by all these sectors given as the GDP-MP, that is sigma GOV, gross value output at market price, equal to gross domestic product at market price. However, this method has the problem of double counting. This problem is solved by using value added method. Gross value added at market price, that is GVAMP, equal to GVOMP minus intermediate consumption. Intermediate consumption means the goods used for the production of another product. That is, these products we do not consume directly. Net value added at market price equal to GVAMP minus depreciation, that is sigma GVAMP equal to GDP-MP. The next is final expenditure method. This method estimates GDP by adding the final expenditures in the economy. There are four major components of final expenditure. Private final consumption expenditure, or C. That is, this is the main part of household sector. This is the household expenditure on final goods and services to satisfy their wants. It is mainly depends upon their disposable income, that is the income utilized for consumption purpose. So these do not the letter C. Next is investment expenditure. This is the expenditure for acquiring capital assets. These are four major components: investment expenditure, private investment by firms, government investment or autonomous government, residential construction investment, inventory investment, unsold, that's etc. The third one is government consumption expenditure. Like household, government also spend money for purchase of goods and services. The fourth one is net exports, X minus M. This is foreign expenditure. Foreigners spend money for our goods, that is export, and we purchase foreign goods, that is import. The difference between those two are the net foreign expenditure. When these two items are added, we get GDP-MP, that is C plus I plus G plus X minus M is the GDP-MP. Once GDP-MP is estimated, we find NNPFC, that is national income, easily. The next method is income method. When production takes place, income is generated in the form of factor payments. There are four factors of production: land, labor, capital and organization. That is, when output worth ₹100 is produced, income equal to ₹100 is generated in the economy as factor payments. Income method takes sum of the factor incomes in the economy. Factor incomes are, the first one is rent. It is the income earned by the people who supply land and building in the production process. Second is interest. It is the reward of capital. When money is borrowed for investment, interest is paid as reward. The third one is wages. It is the reward of those who supply labor power. It is also called compensation of employees. The fourth one is profit. Profit is the reward of entrepreneur. Entrepreneur is the person who combines the service of other factors of production take risk and produce various goods and services. Even though these are four factors income, one more item added, that is the income of a self-employed. The income of self-employed people is a mixture of rent, interest, wages and profit, and it cannot be separated. Therefore, the fifth item is added as mixed income of the self-employed. When these five items added, we get NDPFC, that is R plus I plus W plus P plus mixed income, we get net domestic product at factor cost. So, net national product at factor cost equal to net domestic product at factor cost plus net factor income from abroad. Thank you.